Does revenue mean gross or net? One of the most common questions in business and accounting is whether revenue means gross or net. The answer depends on the context, but in most cases, when people refer to revenue, they are talking about gross revenue, which is the total amount of money a business earns from its sales before expenses are deducted. Revenue is often called the top line because it appears at the top of a company's income statement. It represents the income generated from selling products or providing services during a specific period. Revenue is one of the most important financial metrics because it shows how much business activity a company is generating. Gross revenue refers to the total sales amount before any deductions. For example, if a clothing store sells $100,000 worth of merchandise during a month, its gross revenue is $100,000. This figure does not account for returns, discounts, operating expenses, taxes, payroll costs, rent, or any other business expenses. In some situations, companies report net revenue, which is gross revenue minus certain deductions such as returns, refunds, allowances, and discounts. Using the same example, if the clothing store had $5,000 in returned merchandise and gave customers $2,000 in discounts, its net revenue would be $93,000. The distinction between gross and net revenue is important because it provides a clearer picture of a company's actual sales performance. Gross revenue shows total sales activity, while net revenue reflects the amount the business actually keeps after adjusting for sales-related reductions. Many people mistakenly confuse revenue with profit. Revenue and profit are not the same thing. Revenue represents the money earned from sales, while profit is what remains after all expenses have been paid. A company can generate millions of dollars in revenue and still lose money if its expenses exceed its income. For example, imagine a business generates $1 million in annual revenue. If it spends $700,000 on inventory, salaries, rent, marketing, insurance, and other expenses, its profit would be only $300,000. In this case, revenue measures sales activity, while profit measures financial success after costs are considered. Public companies often provide both gross and net revenue figures in their financial reports. Investors use these numbers to evaluate business performance and identify trends. Consistent revenue growth can indicate increasing demand for a company's products or services, while declining revenue may signal challenges within the business or industry. Different industries may also use the term revenue differently. Retail businesses often focus on gross sales and net sales. Service-based companies typically report revenue earned from services provided. Financial institutions and insurance companies may use specialized revenue calculations depending on the nature of their operations. Business owners should monitor both gross and net revenue regularly. Gross revenue helps measure overall sales performance, while net revenue provides a more accurate picture of what the company actually earns after sales-related adjustments. Tracking both figures can help identify opportunities to improve pricing, reduce returns, and increase profitability. Revenue generally refers to gross revenue unless otherwise specified. Gross revenue represents total sales before deductions, while net revenue reflects sales after returns, discounts, and allowances are subtracted. Understanding the difference between these two terms is essential for interpreting financial statements, evaluating business performance, and making informed financial decisions.